Hi, good morning. Good morning. I was pretty happy with yesterday with our power hour trade. The first time we've gone and done power hour since we started doing these live shows, these live presentations. And so that was a lot of fun to go out there and spend the afternoon with you guys and trade a little power hour. We had a really good power hour. I was pretty surprised. Power hour sometimes you just never know what you're going to get with power hour. It's like a surprise every day. You don't know whether you're going to get a really good, strong market that likes to run or whether you're going to get a dead market. So yesterday, for our first shot at the power hour scalp and trail strategy, we did pretty good. So if you didn't see that and you would like to see that, you missed it, then it's yesterday's video. So go watch power hour. That was we had a lot of fun with power hour yesterday. We'll do that again next Tuesday. We're going to do power hour. So today is Friday. Monday, we're going to trade here in the morning. And then Tuesday, we'll do power hour again. So Tuesdays and Thursdays, we're going to scalp and trail power hour. But today, we're going to do a little bit of options trading. I want to talk a little bit about the long-term trends of the markets. And I want to kind of point something out to you. A lot of people are looking at these markets and they're saying, wow, the economy must really be doing wonderful. And it is. I mean, there's component pieces of it that are doing great, right? What is this type of an economy good for? Well, it's good for the great big giant firms, right? So if we come in and we look at the S&P 500, which are the 500 biggest firms in the whole, basically the whole world, they're doing really well. And if we remember during the pandemic, who was it that did really well during the pandemic too? It was the giant firms, right? Everybody else got closed down. All the other businesses had to close, but yet they were able to keep all the big businesses open. No conspiracy there. But they did really well. And the S&P 500 is doing pretty good. I mean, you have to admit, look at this. This is really good. And if you go back and look, historically speaking, let's see if we can pull up some long-term charts. This is the weekly chart of the S&P 500. All right. And then we're going to pull up, let's pull up the monthly chart of the S&P 500. So each price bar represents 1 month. So this market has just been going just lickety-click, right? It's just been going to the moon ever since this thing opened up back here in 2010. So it's been going and it's been clicking along pretty good. And then right in here, of course, this is the recovery of the pandemic, printing money like it was just like there was no, just as fat. They took out the old engines, the old diesel engine on the printer, and they put in a new Tesla electric engine, electric motors. And they went to town, man. They just started printing money. I think I was looking at the clock yesterday, and we're almost clicking over to $43 trillion in debt. And that $43 trillion is what's pumping this market up. Plus, don't forget, the $43 trillion in debt is pumping up some of these big firms. But also, this is AI. AI is what's really driving this. This is the AI revolution that is turning this thing on to just lighten the fire under this thing. All right. If you want to know what the real economy is doing, all right, you can't look at the S&P 500 because who's going to benefit from all of the money printing and the wars, all that kind of stuff, all the things that drives our economy here in the US is going to be the 500 biggest companies, right? That's why they're in the S&P 500. That's why most of our retirement stuff, all of our retirement accounts benchmark against the S&P 500, right? That's why we do all of our retirement, our savings and our bonds and our ETFs and our, collecting the interest on our money and our debt and all that kind of stuff that we do, we benchmark it against the S&P 500. Because it's the five big hundred markets, right? If you want to know what real Main Street's doing, you come and you look at the Russell 2000, because these are the mom and pop shops. Now, mom and pop shops is not really fair either. These are still companies that are the 2000, relatively biggest companies in the industry. And they don't include all those big S&P 500 stocks. So the market the economy itself is still struggling a little bit. We still have quite a bit of, you know, high interest rates means that these small businesses can't borrow money, and so or makes it very expensive and difficult for them to borrow money. And they have to pay high interest rates to loan and borrow money, and it's hard to start a new business if you can't borrow money at or you have to borrow money at a very high interest rate. So just keep that in mind when you're looking at an economic indicator, that the Russell 2000 is actually a better indicator for the overall broader economy than the S&P 500. The S&P 500 is just the cream of the crop. Now, we're very proud of the cream of the crop in America, right? We love the fact that our S&P 500 is the dominant 500 companies in the world, and we're very proud of that fact, and that's why the US is such a big dominant factor, because we do have, an economy that allows for, or a political system that allows for that type of growth. And so we can be very proud of that. And it's one of the things that's our big feather in our cap, is the fact that we do have that type of thing. But you have to also take into consideration that there's an kind of a little underbelly to the rest of the market too. And that's the Russell 2000. And the Russell 2000 is actually in a downtrend, as you can see, lower highs and lower lows. Now, I don't have much history back here, and it's kind of coming across a little bit. If we went and looked on the stock market side, we'd have a longer history. This is the futures market side, and of course, these markets expire, and so we don't have a lot of history looking at on the Russell here in the futures market. But we could go look at the S&P 500 and the Dow, the Russell, the Nasdaq over in the stock market, where we do have a lot more history, and you'd see basically the same thing. The Russell 2000 is just kind of wandering sideways. And so that's the drifting of the economy, is just kind of drifting sideways. But our big markets, which are being propped up by government spending and by the AI revolution. So that's why we're in this, and we're looking at this. And I want the reason I'm mentioning this is because I don't believe that's going to slow down. First of all, I don't think they're going to stop printing money. The government simply can't. If they do, they'll crash the economy, right? They'll crash these guys. And if they crash these guys, then we're really in trouble. So they can't stop printing money. So they're going to just use inflation to continue to drive this economy. And so we want to be able to get in ourselves into a situation where we can take advantage of inflation, right? Meaning that we do not want to have fiat currency. Don't hold on to fiat currency. You want to convert everything, all your energy efforts and energy and whatever you can to obtain as much fiat currency as you can. But the last thing you want to do is hold on to fiat currency, because fiat currency, inflation is the rate in which fiat currency is devaluing. So the higher the inflation rate, the faster the devaluation of your fiat currency. So we want to get rid of that. Get rid of your fiat currency. You don't want to hold on to a whole lot of cash. Now, you have to have some cash in case you need to go spend it, right? We need to pay our bills. We need to, buy food. We need to go on vacations and enjoy our lives. And, it's not all about, saving money. Who said that? It's not all about, I don't know anything else. It's all about making money, right? Okay. So it's all about, living our lives. But the whole name of the game is that we don't want to hold on to fiat currency. We want to get rid of that crap. Okay. Get rid of fiat currency. We only want to keep enough for emergencies and for the purposes in which we need it, to buy things to live our lives. And then the rest of it wants to go into assets that, if they're not increasing in value, at least they're not devaluating, okay, as fast as uh, as the rate of the inflation. So what are some of those things that you can put your money into so that they don't devaluate? Well, you can buy land, you can buy houses, you can buy, these are the main things: real estate, land, and then what else is there? Well, the S&P 500. I mean, those are kind of the main three things that increase in value. You could buy a car. Oh, wait a second. Cars don't increase in value. All right. Some do. And interestingly enough, you want to see something? I'll show you something cool. I have some cars that I buy. If I can find the little app up here real fast, I'll pull it up for you and show you. It's just kind of a fun thing that I do. Maybe I won't show it to you. Maybe I can't find it fast enough. Maybe I have to show you that tomorrow. Come on. It's right. Oh, there it is. This is my little cell phone. And on my cell phone, I have a portfolio. Oh, it's gonna make me log in and do all that kind of stuff. I'm gonna have to do that tomorrow. I have about 6 investment cars. I invested in cars. It was the dumbest thing I ever did. But I bought about 6 cars as a portfolio investment, and, well, I've lost money on all of them. Let's just say. But it's fun to be able to pull up my phone and show everybody, "Hey, look, I own a Lamborghini." Can't drive it, but I own it. It sits in a museum somewhere, and I'm part share owner in a Lamborghini and a Porsche and a couple other cars, but not a good investment, all right? You need to buy things that, will appreciate in value, and, oh, you can do that too on here. You can go buy art. Now, I signed up for that, but I never bought any because I lost so much money buying cars. I didn't think I was going to do so well in art either. Probably not a great art. I'm not very good at that kind of thing. You kind of want to invest in things you know a little bit about. So I don't know that much about cars, and it was just kind of something stupid I did. But you could do the art thing too. But anyway, those are our 3 big ones, right? We can invest in the stock market, basically the S&P 500. We can invest in real estate, and we can invest in land. Now, you want to also consider for your investments, you want to consider that you can get intrinsic value growth and extrinsic value. Now, a lot of people are running around on the internet and they're telling people don't buy houses. Don't buy yourself a house. Don't buy a house. What do you want to buy a house for? You can just go rent for the rest of your life and then take the money that you would save, which I don't know if that's a rent and save is not those 2 things. That's not like these 2 things, they do not go together. You know, remember when we were kids and we went to Sesame Street and they'd show you these little blocks on the screen and they'd say, which one of these things? They'd show you a hat and they'd show you a shirt and they would show you a pants and then they would show you a truck. Which one of these things don't go together? Remember that? Rent and you paying the rent, right? Not receiving it. You paying the rent and saving money. And those 2 things don't go together, not in my brain. I don't see where that makes you money. They're saying rent your apartment and then take the money that you would save, which I don't know where that comes from, save, and put it in the stock market, right? I've seen guys talk about this on the web, and I'm like, it doesn't make sense. Because the minute you buy your house, you stop the increase of rent. Because I own property, I own real estate, I own a bunch of real estate. And every year I send out a notice to all my tenants. Rent's going up, rent's going up, rent's going up, rent's going up, right? But the minute you buy your house, boom, you stop that. No more rent goes up. Now, your taxes are going to go up, but that's why rent goes up. You pay the additional taxes, right? But maintenance on your house might go up, but they're going to the guy who's renting this thing to you is not going to pay anything. You're renting it from him, you're going to have to pay everything through the rent, or he's not going to do it. Right? You're not going to have a house to rent if he's not making money. So you're going to pay everything that and plus he's got to make a living off of you too. So this idea that's going around the internet of don't buy your house is crazy, because the minute you buy your house, it starts to increase in value due to the increase in, or because of inflation. So inflation is basically going to make payments to your house. They're going to pay your house. Right? And so this is how a lot of people, and I was mentioned that I was going to tell you a little story, and we'll get into trading. We'll go do this here in a minute, but I just want to kind of get this off my chest. You want to talk about intrinsic value, extrinsic value. And the reason I'm talking about this is because it relates to options, and we're going to talk about options. All right. And I'm going to show you a couple of really cool things here. But you have intrinsic value and have extrinsic value. And the way you stop the increase of your or you start to take advantage of an increase of the intrinsic value of your house is you buy it, because you don't want to be somebody else's extrinsic value. Okay, that's what a renter is. When you rent an apartment or you rent a condo or you rent a house, you are somebody else's extrinsic value. You want to be collecting extrinsic value. So you buy a house and you rent it. The intrinsic value is the increase of the value of the house that's going to increase in value based on the rate of inflation, right? So if inflation is high, the value of your home is going to increase quickly. That's why this stupid little house that I bought 15, 20 years ago for $210,000 is now selling for $500,000 or more. This is ridiculous. All right. But that's because 43,000, 44,000, 43,000, $44 trillion in debt has driven the value of fiat currency down, which drives the value of our properties up. Right. So that fiat currency printing, which I don't think is going to slow down. So there's no reason not to get into asset value creation. So you want to own assets. Everybody's like, well, I'll wait until interest rates come down. Well, I'll wait until this happens. Oh, I'll wait until this happens. So you know what? The best time to have bought a house, buy an investment was yesterday. The second best time is today. All right. So just get her done. Get out there and get her done. Get rid of that fiat currency. You think you're hanging on to it and you're going to find a better opportunity. You're losing it so fast in inflation and the lack of increase in value of the property that you could be buying, that the high interest rate, you think you're going to go buy a house and pay an 8% interest rate and you're going to cry and whine and bawl about that. My first house, I think, was 12% interest back in the 80s. Remember, 80s, 90s? Interest rates were up and around. If we could get 10%, we were just like dancing on the roof. We were fiddler on the roof, right? We thought we had just taken the banks for a ride. So these interest rates right now are not high, not in comparison to all of the advantages that you're going to get by getting rid of that fiat currency. The last thing you want is fiat currency because it is devaluating faster than anything. So you want to get your intrinsic value. All right. Your intrinsic value is the house. The extrinsic value is the rent. Now, if you're going to live in it, you're not going to collect extrinsic value, but you are going to collect intrinsic value. So the value of the home is going to go up. So this is what people do who are running out of money for retirement. Most of our baby boomers are retired or getting ready to retire, and they're running out of money. People come to me all the time. Oh, Lan, I'm running out of money. What am I going to do? Well, do you own your house? Yes, I do. How much money do you have in savings? Well, I'm down to a couple $100,000. That's all I have. And that's it. I got a couple $100,000. I'm 65 years old and I own my house, and that's it. You're going to be okay if you work it right. Now, remember, we've got inflation in our favor. So not that you want to, that's pretty, and you got Social Security too. All right. If that's going to last very long, it's probably going to, it'll last. They'll just keep reducing the amount that you get. So one of the ways you take advantage of this is you want to own your house. And it circles back around to these people who are telling you not to own, or you want to own your house because it's an asset that increases in value over time. And that's what you can live off of, is you can live off the value or the increase in value of your home. You're like, well, wait a second, Len, how do I do that? I'm living in my house. I can't sell it. Do I have to sell my house? If I sell my house, then where do I live? Then I have to be a renter. And you said, don't be a renter. So how do I live off the house? Well, there's a couple ways you can do this. First of all, a lot of people will sell their home and move into something smaller. So if you have one of those 14-bedroom homes and there's two of you rattling around in there, which you see everywhere. I mean, I have a Filipino girlfriend, and as we walk around through town and stuff, she loves to go look at the big homes. And she just can't believe it. She looks at it and she goes, how many people do you think lives in that giant house, Lan? I said, probably two. Old lady and an old man. Then they live in that 14-bedroom home. And she just shakes her head. She goes, man, in Philippines, we'd put 10 families in that house. and she comes over here and she just can't believe it. She just can't believe that there's only two people living in these giant homes. So if you're one of those guys, you can sell your home and downsize. You don't need to clean 14 bedrooms and 18 bathrooms anyway. So there is that. You can downsize and take that money, and then you can take the money invested into the S&P 500 in some of these very stable bond funds and things that are not going to crush when the market falls. There's ways that, and then you just live off the dividends that way. But the house itself has value, right? You have all this intrinsic value that you've built up, plus it's going to continue to grow over time. So you don't have to sell your house. What you can do is you can borrow against the house. And you're like, well, I don't want to go out and borrow against my house. I get a loan, then I have to pay the loan. Yes, but that's okay. That's a high interest rate right now. We just talked about that. All right. It's not a high interest rate. It's a lot lower. You're not borrowing it on a credit card at 22%. You're going to go get a HELOC, a home equity line of credit on your home, and then you're going to probably be able to get that at around 7-8% right now. Yes, it's higher than it used to be at 5%, but still it's only 7-8% right now for a HELOC. So you get a HELOC, and then you live off the HELOC, and you don't live off of it and go spend it like, oh, I got a HELOC. Now I'm going to go to, Cancun. No, you don't have any money. So you got to be careful still. Live as if you're a pauper in your 14-bedroom home, but you're going to get a HELOC on your home, and you can now start to spend on that HELOC, and you can borrow where your ends don't meet. All right. You got, my ends are just not meeting, Lan. I'm just a little bit shy every month. Okay. Well, you borrowed on your HELOC, and you're like, oh, then I got to pay my HELOC. Yes, you have to pay just the interest on your HELOC, which is a lot less than selling your home, taking the taxes at 28% or 21% and paying those. So 8% interest is a lot less than 28% tax. And it's a loan, so you don't have to pay taxes on it. So if you borrow on your HELOC against your home, you're not going to pay taxes on that money as you pull it out. If you sell your home, now you have to pay 21, 28% interest, depending on where you're at in your tax bracket. So don't sell your home to get the money out of it. Live in that 14-bedroom home and borrow against it with a HELOC. Now you only have to pay 8% interest, not 21, on the money you pull out, which is the interest, and you don't have to pay taxes on it because it's a loan. And then your house is going to continue to increase in value because they're not going to stop printing money. We're going to always have inflation. Inflation is going to drive the value of your home higher, and you're going to not ever, let's say that your house is worth $500,000. Well, if you start borrowing out on a HELOC, and you just borrow a little bit just to make your ends meet, and in 10 years, you've run yourself up $100,000 in debt in 10 years. Well, your house is going to have increased by $100,000. So you're not borrowing against anything. You're not spending the intrinsic value of the house when you got the HELOC. You're only spending the increased value of the home because it's going to increase in value. This is the one thing a lot of people miss in their brain when they think about this concept. They go in and they say, well, if I get a HELOC and I start spending that money, I'm devaluating the value of the home because I'm spending money. But that's only if you go out and buy four-wheelers and cars and things that don't increase in value. You have to live, so you have living expenses, and you can live off the increased value or the value of your home that increases over time. So you're just spending the increase in value or the inflation rate, right? So if the inflation rate is 5%, well, your home is going to increase by 5% at least. So as it increases in 5%, you spend that money, and the value of your home, let's say at $500,000, you don't ever spend the $500,000. You only spend the money over and above as your house increases in value. So you're in 10 years, your house increased in value from 500,000 to 700,000. Well, you spend that other 200,000, your house, you still got the 500,000. And you're like, well, eventually I'm going to have to refinance my house to have a traditional loan on it to pay off the HELOC, and then I'll have a house payment. Yes, that's true. So you have a house, and then you, in 2 years, in 10 years, probably 10 years, shouldn't spend your HELOC that fast. In 10 years, you refinance your house, you pay off the HELOC. Now you have a small loan on your home. You just get another HELOC, and you use the HELOC to pay off the house payment. And then you live until you die. And eventually, your family, your heirs will come in and they'll sell your home. They'll pay off the HELOC. They'll pay off and they'll still end up with $1 million or $500,000 in house that you get to pass on to your heirs. So live off the live off the growth of the intrinsic value of your home, and you do that through a HELOC, and you'll be fine. So that's how you do it. All right. So if you're struggling and you don't have enough money, that's how you do it. Just live off the future value of your home through a HELOC. And by the time you have to refinance it maybe once or twice, you'll be dead. So who cares? All right. So that's how it works. So make sure you have lots of intrinsic value. That's the point I'm trying to make. When you're young and vibrant and working and kicking ass and taking names, build up as much intrinsic value properties as you possibly can, so that's the whole idea, right? So you can live off of them in the future and not have to work. But a lot of people don't put those two numbers together. They don't realize that's how you do it. And I have to sell everything. No, you don't. You just borrow against it. And then you don't have to pay taxes on it. This is how the rich do it. They don't pay taxes, right? You always hear the rich don't pay taxes. Why? Well, because they everything that they spend is a loan. And so they just have to pay interest, and they pay interest at these high interest rates of 8% as opposed to taxes at 21%. So which would you prefer? Taxes at 21% by selling all of your assets and then you don't have them and they don't grow, or pay 8% interest to the bank so that you can borrow it, and eventually you have to sell it, but then you're dead. Who cares at that point? You're dead. Your kids need to stand on their own. You don't need to provide them with a whole living. That's what their job is, to get their own assets, right? You want to pass something on to them, but worry about yourself first. That's why you're here. Get yourself taken care of and spend your assets. All they're going to do is, if you pass it on to your kids, then the government steps in and takes 44% of it. So you're going to lose 50% of it to the government anyway when you pass it on to your kids. So you might as well spend it all yourself. All right, there we go. That's my rant for the morning. So that gives us the follow-up into what I want to move into in these options. You have intrinsic value and have extrinsic value. And it's easy to understand intrinsic value and extrinsic value when we're talking about real estate, because the intrinsic value is the house and the extrinsic value is the rent. Let's say you buy land. Well, land has intrinsic value and it'll increase in value, but you don't rent it. You could put a horse on it, right? Go tell somebody to raise some corn on it, and they might pay you for that. And that would be some intrinsic value, but you own or extrinsic value, but you own the land. That's the intrinsic value. And as it increases in value over time, which it will, that's a great thing to have, but it doesn't have any extrinsic value. So that's why owning a property where you can rent something is better than just vacant land. Nothing wrong with vacant land. It'll increase in value, and it's better than having cash. And it's low maintenance generally, just dirt. So there's not a whole lot of maintenance. You'll cut the weeds every now and again. But if you put a horse on it, you can get a little bit of extrinsic value. But if you buy a condo, or if you buy an apartment complex, you can rent it, and then you have intrinsic value and extrinsic value. So I have real estate, and my real estate has gone up tremendously in value. So I have a lot of intrinsic value there that I could eventually live off of if I wanted to, borrow against it, right? And have that to live off of. Plus I've got renters in there. So I've got people paying me an extrinsic value. Now let's convert that idea and that concept as land. I don't want to go worry about renting properties to people. And I've kind of stopped that too. I'm not buying a whole lot of rentals anymore. And I say that just as I bought some more rentals, more than a couple of weeks ago, but I'm looking more towards the stock market to do that for me. And so I'm putting money into some of these more traditional bonds. My son's a certified financial planner, and he's been helping me do some of these things. I'm more of a trader. Me, I'm just like, let's get in there, lower highs and higher lows, and let's buy all this crap, right? So the whole idea is to put your money into some of these longer term bonds that have intrinsic value and also throw off extrinsic value. So if you buy the intrinsic value, you want the item that you're buying to increase in value. That's called the NAV. All right. The NAV in the stock market. Just think of the NAV as the amount of money that the underlying asset is making as it rises in price. So when you invest your money in the stock market, you generally want something that has a positive NAV. You want that NAV to go up. You want the value of the item that you own to go up. Now, there's a lot of things that you can invest in the stock market where the NAV doesn't move. And those are good too. Those are very stable. Those are generally bonds, right? So you got things that are government bonds, you got treasury bonds, you got that type of stuff. Those things don't have a very strong NAV. They got a very low NAV, which means that when the market falls, they're not going to fall, but when the market goes up, they're not going to go up either. You have corporate bonds. Those are generally pretty good because you can get a pretty good extrinsic value, or in the stock market, we call it your dividends, right? You get a dividend. Now, what I like, and I'm still pretty aggressive. I'm only 60 years old. So I got a good 10 years before I have to retire. So I'm still, man, I'm losing my voice. Hold on a second. I'm lecturing too much today. So I'm still being a little bit aggressive with my investments, but I want to put things in where I have a strong NAV, and where you get the strong NAV lately has been in the S&P 500. Now, the reason I want to bring that up is because I want to show you the Fibonacci numbers on the S&P 500. We're due for a pullback. All right, there's your ABC pattern, and this market's come down through this drop here. Now, if you got to look at this thing from a longer term basis and anticipate what's going to happen. You got to be careful. But this is our drive one, right? This is a drive one. We know about drive one. This is drive two. So we'll probably get a little pattern in here where this market comes down, rallies up. It's going to probably come back down to this region down in here somewhere, right? Tie off this. Now, what we don't want it to do is just start to wander sideways. And it may do that, but I don't think so. And so this is what I'm kind of part of what I want to talk about today. I don't think this S&P is going to come down here and crash. A lot of people are talking about a massive crash on the S&P. And I don't think the S&P is going to crash. Why? Because one, the government's not going to stop printing money. And so they're going to keep pumping money into, I mean, Biden just went to Ukraine and signed a 10-year non-negotiable, so whatever presidents come in for the next 10 years still have to uphold to this. Now, I don't know how he can do that, but they're going to still be sending billions and trillions of dollars to Ukraine for the next 10 years with the documents that he just signed over when he was over there last week. All right. So I don't know how a president can say that the next president can't stop that, but unless it gets passed by Congress, and he didn't approve it through Congress. Congress didn't do that. He just went over there and said, we're going to give you money for the next 10 years to run this war against Russia. So the U.S. wants to keep that Russian war going for the next at least 10 years. So that means they're going to be printing money and giving it to the military industrial complex, which is a large part of what drives this S&P 500 up. All right. Plus all the other contractors that take money away from, that the industrial complex buys from. And the other side of this is the AI revolution that's pushing this S&P up. So the S&P 500 is being driven by this AI revolution, which is just beginning. It's just beginning. I mean, we're just getting into this thing. This thing is going to change the world, and the money that's flowing into it is unbelievable. So, a lot of the driving forces behind the S&P 500 have been the ungodly amount of money that the government is printing and sending into the economy through primarily the military-industrial complex, and then this ungodly amount of money that is being pumped into AI. And so the AI revolution is what's driving this big trend. Now, if you look at this dip right in here, if you notice, the dip only took 2 months. I mean, literally 2 months for it to recover to its full amount on that last dip. We're in drive one of the new drive two of the new drive. I think we're going to get a drive three. I think this thing's going to come down and we're going to get another drive. So this is going to be a buying opportunity as this thing comes back and starts pulling back into our Fibonacci bow tie. This is our target for the downside. Doesn't mean it can't dip a little lower. It certainly can. Doesn't mean it can't stop and start to go a little quicker. It certainly can. These are just target points that the Fibonacci models point out to us. So these are going to be buying opportunities as this market gets down into this region here. We're going to start wanting to look at dumping and pouring more money into S&P style returns and ETFs that have high dividends. Now, a lot of the high dividends that are coming are the way that a lot of these funds do this is they sell options premium to collect the premium, and then that's how they distribute the dividends. So their underlying investment is in the S&P 500, and then they sell premium to collect the dividends. So you have a strong NAV, which is the market going up, plus the dividends off of the premium of the options that they're selling, and then they distribute that as the as the as the extrinsic value. So that's how you get intrinsic value, which is the NAV of the market moving up, and that's how you get extrinsic value from the stock market, is from the selling of premium options, so that you now get a rent on your money. Okay, so that's your dividends. So when you invest in the stock market, you want to try and do the same thing that you might do in the real estate. You don't just want to buy land, which you can. You can certainly do that. If you go out there and buy Microsoft, Microsoft started to give a little bit of a dividend, not much. They're still consider themselves growth. But there's some bigger companies like IBM. If you just buy IBM, they they have not a very strong NAV. Not that they don't, they still do. They increase in value, but they're such a monster company. They kind of increase in value very slowly, but they throw off a pretty good dividend. So I'm losing my voice. So right now, because the interest rates are pretty high, some of these dividends that are being kicked out of some of these markets, we're up around um, 10, 8, 9, 10% interest is being kicked out by some of these markets, and in combination with the NAV of the increase in value of the underlying asset, plus the options which are being kicked out, plus the stock that they hold in the NAV in the in the intrinsic value of the ETF, right? They're kicking out some. Now I need another drink of water, another drink of tea. You end up with three types of income. It's the point that I'm trying to make here with some of these ETFs. So you get the intrinsic value, which is the rise in price of the ETF, of the basket of stocks. Those stocks are going to, many of them, give you a why did that word just slip my mind? Help me out, folks. My brain just went dead on me. That's embarrassing. I got to write some notes down so that when I get my brain start going like that and then it breaks, I can look down at my notes. Okay. So you have your intrinsic value. That's the value of the stock, the underlying stock. That relates to the building that you bought, or the house or the apartment that you bought. That's the intrinsic value. You then have the extrinsic value. The extrinsic value is the rent that you receive from renting the apartment. In the stock market, the intrinsic value is the stock you own, or the ETF, the basket of ETFs. The basket of ETFs is going to throw off what we call a dividend. There's the word that slipped my mind again. So a dividend. The dividend is the rent that you are receiving from the apartment, but it's also the dividend is the profit sharing that the company gives you when you invest in the company. So you can go out and buy an individual stock and they will give you a dividend. Or you can buy a basket of stocks, which is an ETF, exchange traded fund, and then all the stocks within that basket are going to give a dividend. And then oftentimes these companies will then sell options against it to collect a premium, which increases the amount of money that they're making off of those basket of stocks that are throwing off dividends. Then you get that premium as well, which also comes to you as part of the dividend. But it's a different dividend than the dividend that's coming to you from the businesses as a profit sharing. They're collecting premium. And you notice that how all these companies, all these big banks, Chase Bank, BlackRock, all these great big huge firms, when they do this, they're not buying options. I don't know any of them that buy options. Doesn't mean they don't. Now, I'm certainly sure there are some that buy options to increase the value of their holdings, or to share their dividends, because you get the intrinsic value, the NAV, the ownership of the stock, which increases in value. You get the dividend that comes from it, the profit sharing of the profits that the company throws off. Some don't share their profits. Apple just hasn't shared any profits, hasn't done dividends forever. I think they just finally started getting a little poultry piece of, give you a little piece of the action of Apple. But they consider themselves a growth stock, so they don't have to give you a dividend. It's one of those things. So there are stocks that don't give you dividends. So they're not going to, they're going to compound in growth as they grow, but they're not going to, you don't get more shares. And the whole idea is you want to get more shares. If you buy 100 shares of Apple and it goes up, you never have any more than 100 shares of Apple. All right. It's like your house. Your house is going to go up in value, but you don't have now 2 houses, 3 houses, 4 houses, 5 houses. You still only have 1 house, but it went up in value. That's the same as buying an individual stock. You buy an individual stock and it goes up in value, you still only have 1 share of stock that went up in value, or 100 shares of stock that went up in value. The whole name of the game is you want to do compounding of your stock. So you want to get 2 shares of stock, then 3 shares of stock, then 4 shares of stock, then 5 shares of stock. That's the value. That's the magic of the stock market over real estate. All right. So it's taken me a little bit of time to get here, but hopefully I'm bringing you along with me. So we have the intrinsic value. We have the which is the NAV. We have the dividend. And then we also have a lot of these companies, or a lot of these firms, will also sell premium. They don't buy options. They sell it. They sell premium, collect the premium, and then they give that money to you as part of the dividend. And that's how they can get up to 20, 30, sometimes 30% returns on some of these funds, because they got a strong NAV, which is growing fast, usually the S&P 500. And then they have the dividend that the companies are throwing off by owning the basket of stocks. Plus you're receiving premium from selling options. Now, what are these? You want to know what those are? I'm giving a couple of them away to you. One of my favorites is called SVOL. If you go into the stock market and you pull up SVOL, it's one of those funds that does that. I've got about 30 of them in my portfolio. I can't give them all to you right here, but what I can do is I can tell you about Pitt News Magazine, because we've now started to put a section in Pitt News Magazine talking about these ETFs and ETNs that give you these high returns, where you get the intrinsic value, you get the dividends, and you get the extrinsic value of selling options premium. All right. I know it was a long circle, a long way to get around to that, but I wanted to really drive the point home. You have the NAV, which is the increase of the value of the stock. You have the dividends that come from the basket of stocks if you're in an ETF that throws off dividends. And you also have the extrinsic value of the options. And these are some really good funds that you can get into. And we're starting to have a section in Pitt News Magazine where we highlight each issue of this magazine. We're going to highlight at least one of these and show you which ones are doing this type of thing. And we do all the research. We're going to compare them for you against the Qs, the S&P 5 SPY, and we're going to use those as our benchmarks. And we're going to show you how they are doing better, worse, how they recover better, how they recover worse, and which ones of those you can start investing in. So you're not just putting your money into the Qs or into the SPY. You can now start going into some of these other funds that use the S&P 500 as the NAV, which then gives you the dividends, but then they also sell options premium and collect premium. So you're getting a much higher interest return on your money, which then gets reinvested, and you start buying more every month as you get reinvested, a reinvestment process where now you start off with 100 shares. Now you have 101 shares. Now you have 105 shares. Now you have 200 shares. Now you have 600 shares. And it just continues to build, all right, on top of itself. That's one of the 7 wonders of the world, right, is that compounding effect. So there's an article in Pit News Magazine where we started that last month, and then we're really getting into it. We're going to do another one. I got another one highlighted in this month's Pit News Magazine, and then we're going to delve into these a little bit deeper, because when you make money over here in the stock market the way we do it with day trading and stuff, you got to be able to pull your money out of there and put it over into some of these ETFs, ETNs, and some of these high yield return bond style funds. All right, and grow your wealth that way. So that's what I've been trying to get around to. And then I want to take you over and show you that and my comment about most of these funds, these big funds that are doing this, they're not buying options. They're selling options. They're collecting the premium. Why? Because it's a safer way for these big funds to make more money, is to collect premium. So that's why we're focusing ourselves when we're doing our own trading with our own options. We can do the same thing here in the futures market. We're selling premium. That's why the wild eye, crazy eye, iron butterfly has been such a big deal for me lately, is I want to create a method of collecting the premium the way these big boys do. So no, we're not paying the premium. We're not paying rent. We're receiving the rent. All right. We don't want to pay rent. That's the premium you pay when you buy an option. Not that you can't. We certainly can. I like to do that. Had a really good day doing that yesterday, buying options and trading explosive stocks. And Doc Brown's into that. He likes to do that too. But I want to talk to you about collecting the rent, collecting the premium. So we're going to be doing a lot of this research, and we're going to be putting all that research into Pit News Magazine. That's what Pit News Magazine is. It's a research magazine. It's where we do lots and lots of research into the markets, and then we document all the research that we do so you can do it yourself and learn from this. And that's all in Pit News Magazine. You get the first 3 months for $1. You can try it for 3 months. If you don't like it, you can cancel, and it's got a 90-day satisfaction guarantee. We'll give you your dollar back. All right. It's the only thing I ask for in this channel is to support Pit News Magazine. 1 full year is $49 after that. So you have the first 3 issues, and then you get 12 more issues for $49. It's where we're going to document all these wonderful things. This is where we learn about everything that you're talking about and what we learn in this class. All right. So go and pick up Pit News Magazine, and it's going to be a great tool for you to come along and learn all this stuff in. And then we're going to come in here and we're going to trade and have fun and learn about the intrinsic value, extrinsic value, dividends, and how to do this yourself. So that's what I wanted to talk to you about. And one of the stocks that we're going to be talking about in Pit News Magazine this month is going to be SVOL. You can go pull that up in your stocks platform and you can look at it. It's a pretty good fund that does exactly what I just said. The NAV is based on the S&P 500, which also throws off dividends. They also sell options premium, but actually I think SVOL is not against the S&P 500. Sorry. SVOL is against the VIX. The VIX. Now remember, we talked about the VIX. If you weren't here for the VIX discussion, go back I think it's 3 or 4 or 5, 6 videos ago, and you'll see the VIX and the skew. Go watch the VIX. You'll learn what the VIX is. But the SVOL, and that's a stock symbol. That's not a future symbol. SVOL is a fund that you can put your money in that trades the VIX. So there's going to be no dividends because the VIX doesn't throw off dividends. But they sell the premium and collect the premium off the VIX. And then they distribute that as a dividend. So you end up getting a dividend. Okay, so it's a pretty good one of the funds that we're featuring in Pit News Magazine in the July issue. And then I got like I said, I've got about 40 of these things in my portfolio, and I've got a pretty diversified portfolio, and I'm testing some of them, running lots of money in some, a little bit of money in others, seeing how they all perform. And I'm gonna share that with you. I'm going to share all of my results with you in these different funds, which ones are performing the best, which ones are a little bit more aggressive, which ones take advantage of the S&P 500, which ones, are struggling here with the Russell. So some of them not doing so well. Russell's not doing so well. Small Main Street companies are not able to grow like the big giants are. So keep that in mind, that you got the big giant companies, NASDAQ, of course, this is the AI revolution right here. You got the Dow, which is the industrials, Okay, so the industrials, and then of course you got the S&P 500, which is a combination of all of the above. So that's why I think that the S&P 500 is not going to fall. Everybody's out there yelling and screaming the world is going to come to an end, and it eventually will, because the U.S. can't continue to print money at this rate forever. Even though Biden's trying to increase the amount of money that you got to slow the printing. And by slowing the printing, it's going to slow the growth of the S&P 500. So he doesn't want, he's going into an election year. The last thing he wants to do is turn off those Tesla motors on the printing money printing thing. We're actually spending more money on the interest right now than we're spending on our entire military industrial complex expenses. So the interest rate is just getting absolutely ridiculous. And so there's going to have to be some adjustments made. But right now, he's not slowing anything down. And so he wants to win a re-election, and he wants this thing to go to the moon. And that's how he's going to do it. He's going to do it through printing money. So if this thing continues to go up, we want to be mindful of that, but also be mindful that we want to start putting some of our money, a large percentage of that money, over into things that don't rely on the S&P 500. So that's going to be corporate bonds. It's going to be U.S. bonds. And then they're going to also do those. You want to find the ones that are selling options premium and collecting that and distributing that as a dividend, because you can't, if your NAV is going down faster than your dividends are going up, that's not good. The value of the stock falling is not going to be outperformed by just because you have a 10% dividend being paid out to you. Your NAV is going to lose way more than that 10% dividend is worth. I oftentimes say, don't worry about the dividend when you're trading and you're trying to just go after explosive stocks. Don't worry about the dividend, because it's such a small piece of what it is, of what you're trying to gain on the longer term trends. All right. But this is how you do it. So this was the lecture that I promised that I was going to give to you. I was going to show you how to live off of your house without selling it. You do it through your HELOC, and then you refinance, and then you pay the interest instead of the taxes, which is a lot less. And then you can live until you have to eventually, and you just live off the growth, the continued growth of your home. And then you can do the same thing, and you can kind of replicate that in the stock market using some of these bond funds. Okay. And again, this is all going to be documented in Pitt News Magazine. If you don't have it, go get it. And those of you who do have it know how wonderful that magazine is. I think that it's a pretty good magazine. We've been running it. I've been publishing Pitt News Magazine for a long time, like 20 years. But we kind of, with the advent of AI, artificial intelligence, we've been able to do a whole lot more in Pitt News Magazine than we ever were before. So Pitt News Magazine is way better. Our grammar is way better, which is our grammar and spelling has increased significantly since AI. So we had Grammar Checker in Microsoft, but it wouldn't kind of help us rewrite our sentences so that so the grammar was even more proper. So it's helped us in that way. Our articles are much more professionally written because we do have AI helping us write our articles. So that's been a big bonus. But we also have the ability to have audio on all of the articles, so you can listen to the articles. All right. So you don't have to just read them. You can also listen to them like podcasts, and then you have the notes. So AI has really helped us make Pitt News Magazine. Plus, a lot of the pictures, not all of them, but a lot of the pictures are done with AI. That cover on that last month's magazine, look at that cow. That's pretty cool, right? Look at that cow. He's all dressed up in a nice suit and tie, like a rich cow. Because, well, a bull. Let's call him what he is, right? He's the bull for the stock market. So we got a stock market bull on the cover of the magazine. That is a cool picture. That was done with AI. So a lot of the pictures in the magazine are done with AI. And so that's really been helpful too. It's put a lot of color into the magazine. It's made it really exciting and fun to look through. And the articles are still, helped us with the grammar and the spelling. And we still got a nice little team of people who write articles with me. So they write the articles with me, and then we run them through AI, make sure that the spelling and the grammar is good. And then we can have some pictures go along with it. And AI's really helped with that. And of course, the audio going along. And it allows us to, with a smaller staff of people, give a higher quality magazine. So we've been using AI and we love it. It's been wonderful for us to help us with that. And so if you're participating and you're subscribing to Pit News Magazine, you are part of the AI revolution. You're actually participating in and benefiting from what AI has been able to do for us with Pit News Magazine. So a lot of people are like, well, I don't know. I haven't got any use for AI magazine. I don't have any use for AI. What am I going to do with it? Ask it a question once in a while, how do you spell something and that's about all the use I have for AI. Well, just by being a subscriber to Pit News Magazine, you're participating in the AI revolution. This is helping us provide a better product and service to you. All right. So we use it for you. All right. So let's get in here. And again, I've done a little bit of analysis on the S&P 500 for you, what I think is going to happen. Now, I'm just some guy on the internet, and I've been doing this for a long time, but my projections are what they are, and I'm sometimes wrong. So this market could collapse and it could flush. And I know there's a lot of people on the internet saying it's going to come all the way down and it's going to fall out of bed. I don't see any signs of that. I think the AI revolution is blowing this thing up, and we're going to see this thing go back up. And if we get a little bit of a rebound back down in here on this Fibonacci bow tie, for us, that's going to be an opportunity to buy and put some more money into the markets and watch the NAV continue higher. And that's what we want. Right now, I'm investing in markets that have a strong NAV, which is the S&P 500. Okay, so I do have a bunch over in the bonds and the stuff that's a little bit stabler, but it's not giving me the returns that the S&P is. I may be wrong, and it may collapse out, and part of my portfolio may drop because of it. But I am taking advantage of this military industrial complex growth through the war, plus also the AI revolution. So that's what's pushing these markets higher. And for us to participate in that, there's a number of ways we can do that. And that's why those funds are important. All right. And if you just want to buy the S&P, just go buy SPY. SPY is just a basket of funds, right? The basket of the S&P 500, SPY. And you just put your money in there, but it doesn't, it throws off a dividend, but it doesn't have they're not selling premium in the SPY to collect that as well, give it that extra boost. So what I want to do now is I want to come over to the 15-minute chart. Gotta drink some tea again. All right, so we're going to come over to the S&P 500, and we're going to sell some premium. All right, so this is the S&P 500. We don't own the S&P 500. We don't have the long position that one of these funds might do. And I'm going to get you the symbol for one. Maybe tomorrow I'll go look one up specifically for what we're talking about, where the S&P is the NAV growing, plus we're getting the dividends, plus we're getting the extrinsic value from options. I've been writing that up. I'm writing another. I don't know if I want to call it a book. I'd probably call it a white paper, but I'm having AI help me write a document on my portfolio of all the things I've got in my portfolio that I'm trading. And it gives a complete description of each one of my stocks or one of my bond funds or one of my ETF funds, all the things that I own. And it's talking about all those different things that I just explained to you. And so part of that's going to go into Pit News Magazine, but I'm also going to have that document that I'll be able to give to you guys so you can have my entire portfolio and all the stocks that are in it and why they're in there and how I've diversified across. Now, I've got too many. Obviously, I've got too many. I got like 40, but that's because I do a lot of testing. That's who I am. It's what I do. So if I see a new fund that I like, the way I remember that I want to look at it is I put money in it, and then it shows up in my portfolio, and I'm like, oh, why is that in my portfolio? Oh, I wanted to look at that one. So then I do research on it, and it's got a small amount of money in it, maybe $1,000 or something. And so that one I'll say, oh, that's one of my test portfolios. So I watch it and see how it performs, and then I do some do that kind of research. And that's how I have like 40 different stocks or 40 different funds, ETFs, most of them in my portfolio. And I'm going to share those with you, show you which ones are performing the best and which ones are not. So that, again, a lot of that's going to be published in Pit News Magazine, so you can get it there. But I'm going to also publish a document. It'll come out as a PDF, probably. And I'll give you the PDF, and you can have that too. I'll probably sell it to you. probably sell it to you for $1. But just because of all the work it's taken me, I think my time is worth a couple bucks anyway. So I'm also rewriting my manual that's out on the out on Amazon. So this book right here, my book that is published out on Amazon that shows you how to do all this trading. We've been doing so much research lately. I want to add it into it. So there'll be a version 2 of this coming out that's got all this research into the book and add on to that one. This book also was written before AI. I wrote it a couple years ago, so there wasn't any AI and didn't help me write this book. So if you don't like AI, buy this book. If you like AI, my next book is going to have all the grammar have all the grammar and spelling fixed that was in this book, and then it'll read a little bit easier and quicker too. All right, so we're going to collect some premium. So we have the NAV, we have the intrinsic value, we have the extrinsic value, which is the dividend, and we also have, for us, we want to collect some premium. Now I know what's going through your head. You're sitting here saying, all right, why do I do this at all? Why don't I just go put all my money into these bond funds? Well, because those bond funds and those ETFs, although give you good return, they're only like 10%, which is a lot. Don't get me wrong. They're only like 10% a year. And unless you have like $1 million already, 10% a year is $100,000. That's good return. So if you have $1 million and you want to make $100,000 a year, well, you can have a diversified portfolio like mine, right? With, of course, you don't need to put it into 40 different markets. That's a little extreme diversification, but you can put it into some of these diversified funds, and then it'll throw off the dividends and the premiums, the extrinsic value, and give you $100,000 a year income. That's the whole idea of what we're doing here. We are here to earn money to put into those funds so that we don't have to work eventually, right? So we have this money just coming in from the extrinsic value and from the dividends of the funds that we have our money in. And we do that. We'd rather do that rather than buy apartments and complexes, because then we don't have to change, garbage disposals and water heaters. I got to go replace a water heater this week. So after this class is over, I've got to go have a meeting in 30 minutes. I got a meeting to go change a water heater in one of our apartment complexes. I'd rather not do that, which is why I'm not buying any more real estate. I'm going to start focusing more of my money and that's diversified too. I mean, because the S&P could fall, and then the stock market could collapse. My renters are still going to have to live in their houses, and they're still going to have to pay rent. So that's my diversification too. I have diversified into real estate so that if the stock market's not performing, usually they go like this. So that's why they're good to have kind of a diversified portfolio that way too. All right. So we're going to come over here, and we need to collect money more than 10%, because we can put into the futures market. Now, in the futures market, we have the leverage, right? So we can come into the futures market, and with our leverage, we can put in a small amount of money and make a big return. So we can make 10% a day, right? Or 15% a day. And that's pretty good, as opposed to waiting, an entire year to make 10%. So we make our 10% today, and we realize we're doing a very risky thing here. You don't make 10% a day without taking risk. So if the risk is beyond you, don't do it. Go do something else. Go work at a gas station and earn money that way, and then take whatever you make from that and put it into these funds and grow your fund up to $1 million. You think, oh man, some of you guys are like, $1 million, I'll never be able to get there. You can, because you're going to have time and growth and exponential growth, but sometimes you have to take an extra risk to get a bigger growth. And the older you are, unfortunately, some of the baby boomers, we're up in our 60 year. I'm the very last year of the baby boomers, and I'm 60. So we got lots of baby boomers ahead of me, which are older than me and have no retirement. They have no money, and they don't know how to live. And so that's why I teach, I'm teaching you this. Well, you can borrow against your house and help you understand that concept. But a lot of guys don't want to do that either. Like, well, that's risky. Well, at some point, you're getting to the point where you have no money, you didn't save anything, you're gonna have to take some risks. And it's like, well, I can't take the risk. Well, don't do it then. You're gonna have to keep working at a job, maybe go be a gas station attendant or, go work as a greeter at Walmart or something and make some money if you're not gonna take a risk. Otherwise, you can learn a skill like trading and you can take a little bit of a risk. But that's why I'm here to tell you, you got to be so careful. A lot of these guys on the internet, they want to show you to go in and trade with 15 contracts. Well, that's really cool when you're right. But if you're right only, 33% of the time, you only have to be wrong once with 15 contracts and you're done. You're done. It's already risky. It's already high risk. Already making 15-20% on your money with a single contract. What kind of money are you talking about making if you're going to trade 15 contracts right out of the gate? A stupid money is what that's called. It's called unbelievably stupid money. That's so much money that you could make in just a short amount of time with 15 contracts that it blows your mind that you could even make that kind of money. That's even possible. Is it possible? Yeah, it's possible. You get really good at it. And if you got a big enough account, right? But that one or two times where you're wrong is going to throw you for a loop. Can you get there? Yeah, you could probably get there. Most of us are going to, most people, most traders, when I was in Chicago, most of the traders that I taught were trading most of them were trading between 1 and 3 contracts. You realize that the pro guys that were standing on the floor were trading between 1 and 3 contracts. They would get up into the 5 and 10 contracts. I had guys that were trading the 5 and 10 contracts at a time. And that was on the floor trading their own money. Now, the guys that were trading for funds or trading for companies, they were obviously trading 50s and 100s at a time, and they would go boom like that and they would buy 100. Boom like that, they would sell 100. Boom like that, they'd sell 500. Boom like that, they'd buy 500. So there were those guys on the floor, but they weren't trading their own money. They were trading somebody else's money. They were trading a fund. But the guys who were trading their own money, they were trading 1s and 5s. And these are the pros on the floor in Chicago. 1s and 5s and 10s at the most. I didn't see most of those guys. They didn't trade much more. Most of them were onesie twosies. Most of them trading their own money on the floor were onesie twosies. They would get up into the 2s, 3s, and 5s sometimes, but mostly they were trading onesie twosies. Because onesie twosies in the futures market is still a lot of leverage. You can make 10% a day in a heartbeat. Okay. So 10% a day is a lot of money. That's a lot of money. And you don't want to lose that either. People they have unrealistic expectations. So what we want to do is we want to be very careful, very cautious, grow our positions, and we can make a lot of money in here very quickly. You're like, oh, you're disappointed. Oh, Lance sucks. He only made $500 today. All right. What professional job can you go do that's going to make you $500 a day? Not very many. Not very many. You might be a doctor or a brain surgeon or, some of these guys, they're going to make more than $500 a day. But, an engineer, my son's an engineer. He doesn't make $500 a day. Right? So $500 a day that's pretty average. That's what we try, and that's our goal for the day, right? With just trading onesie, twosie contracts. So once you get up and trading 2Z, 3Zs, 4Z, 5Zs, you can make a lot of money. I'm just trying to bring people's feet back down to earth and stop thinking that you're going to come into this futures market, trade 15 contracts every day, and then 10 minutes be rich, rich, rich beyond your wildest dreams and never have to work again because you just made $42,000 in 8 minutes. Does that happen? Yeah, it can happen. But don't think it's going to happen to you every day, and don't think it's going to, it's a real rare thing that people can actually pull that off. All right. Don't have unrealistic expectations. The people who blow their accounts up are the ones who are trying to take these ungodly types of risks so that they can make the ungodly amounts of money. Is it possible? Yes, it's possible. But it's probably not for you and me. All right. For the most normal, typical guy that's in here trying to make a little bit of money, we're not that guy. All right. So are there those guys out there? Yes. Do the guys on YouTube pretend to be those guys? Yes. Most of them are pretenders. All right. They might have done it once or twice, but they're not going to last long if they're taking those types of risks. And it's so different. This is If they were, I just tell if they were making that kind of money that most of these guys on YouTube say that they're making on these YouTube channels, Wall Street would be knocking on their door. There'd be 42 guys from New York City standing on their door in Logan, Utah, pounding on the door saying, "Man alive, you're making that kind of money hand over fist every single day, like you say on your YouTube channel? I'm going to grab you around the scruff of your neck and drag you to New York City with me. You can't sit here in your bedroom and do that for yourself. There's no way. If you got those kinds of skills, you're going to New York." So when I watch these guys on these YouTube channels making this, oh, I just made 15 contracts, I just made $8,000 in the last 6 minutes. Now I'm going to go off and, sit by the beach now in my mega home. No, they're lying to you. Because if they were making that kind of money and they could consistently do it, Wall Street would be yanking those guys out and they'd be living in a condo on the 84th floor on Madison Avenue. All right. That's my rant and rave. Let's get into trying to make, let's make a little bit of money for ourselves. We're going to come in here and we're going to do what these big firms do. These great big firms sell premium. They collect premium because it's the scare quotes, it's the easiest way to make money in these markets. All right. By having somebody else pay you rent. So we're going to rent out the S&P 500 and we're going to collect the rent on it today. And the way we're going to do that is with our Wild Eye, Crazy Eye, Iron Butterfly. So we're going to come in here, go into options, and this is the 15-minute chart, and we're going to look and see what the options are trading for right now. I think it's going to be a quiet day. I already looked at the economic news calendar. I don't think we're going to get a big move in here today, but we might. The market, we looked at the daily chart, looks like it wants to fall a little bit, so it might be coming down a little bit. So we're going to come in here, and we're going to calculate and see what our premiums are. So we're going to come in here, we're going to sell. I'm going to come to the options chain. We're going to do 0 days till expiration. I couldn't do one yesterday because there wasn't a zero. So we're going to come in here, we're going to sell this one, and we're going to sell this one. So how much premium are we collecting? $987. All right. That gives us a margin requirement of $12,527, but we don't want to do that. We don't want to have that kind of margin, right? So we can't put this on first. We have to buy our wings first. But I'm going to come in here and what we're going to do is we're going to come to a 1 day till expiration. Oh, all we got is 3 because it's the weekend. Go back to what we were talking about earlier, where should we do this over the weekend? And I don't see a reason not to. Might give us a little bit extra cost, but it's going to also hang on to the premium a little bit better. So we're going to go 1 click out of the money. It's all we're going to do. And we're going to buy that one. That's the call. And we're going to buy a put. 1 click out of the money. So there we go. So that's our strategy right there. So these are our insurance policies. They're $700 and $600. You're going to end up paying $412 for this. But remember, these options that we're buying down here have 3 days till expiration. We're going to liquidate them at the end of the day. And so they're not going to really lose. We're not going to really have to pay $737 for them. We're going to pay very little, in fact, because the theta is not going to decay that much. So we're going to get good coverage in case the market does leave our cone of probability, but we're also not going to have to pay that huge premium that it shows here. This is kind of the scary part that people are like, oh, land, I don't want to do that. That's a $400. But look at your margin requirement. It's only $500, not the $1,200. So we're going to collect the premium on this option. And we're also going to be insured by this market here, or by these insurance premiums. Now there's a put skew in there. Notice that our option for the call option is $675, and the premium for the put option is $737. That's because more people buy put options because they buy them as insurance policies to the downside, right? That's why they're more expensive. That's called the put skew. And again, that's all documented in this month's issue of Pitt News Magazine, where we talk about put skew, theta, how it all works to collect premium like these big boys do, right? They collect premium. They sell options. They don't buy them. They sell them, and they collect the rent. And so that's what we want to do. We want to kind of do that same thing. But we have to put these insurance policies on. I'm not putting it on right now. That market's dropping pretty good. Let's cancel this for the second and see what's coming on. Because we don't want to put these on when markets are dead. We don't want to put them on when the markets are flying high. Let's come over here to a 2-minute chart and see what it's doing. Oh, it's not that bad. Lan, you're freaking out over small moves. Okay, let's draw our rigatoni in there. See, it's down. So our put skew is going to be a little bit stronger to the downside. So we could play that. We could say, well, we don't think the market's going to rally hard today. So we could push that top insurance policy out one extra click and not have to pay as much for it. And we could suck that put one, the lower one, up one more if we wanted to. Just watch it for a second here and see what's going on. Let's go out to a 5-minute chart. Turn on Heikin Ashi. So 3 o'clock this morning. This was yesterday, 12 a.m., midnight. It moved a little bit, and then so that's kind of the channel it's in, the directional move. If we take a little bit less, we got this one, and if we go one less, it's still kind of, that's the channel. So that's our one standard deviation away from the market. But we know that from our recent discoveries, our recent research, again, helped by AI helped me do that research. So we learned that 66% of the time the market will leave this box, which is why we need to have the insurance. So looking at this market, are we more bullish on this market or more bearish? And in this case, I think we're more bearish on this market, right? We're coming up here to the Fibonacci. We hit the 100% Fibonacci number just like a train on rails. And now we're looking for it to come back and create this bow tie. So if any of you are long the S&P 500, you just want to kick out of it for a few days, just for fun, you could kick out of it for a few days in anticipation it might come back to here and then go up again with our drive 3. So that'd be drive 1, drive 2, drive 3. So we are bearish on the market. Doesn't mean it can't just make a little move here and continue rally. You certainly can, and then you'd feel bad that you got out, but you don't need to get out. You could just say, well, when it gets down here, I'm going to start buying more. It just depends on what your funds are. Have some money always sitting in cash so that you can always have the opportunity to buy some more. So that's what we're looking for. But today it looks like it's coming down. So we want to be a little bit maybe put skewed to the downside. So let's come back in and put our options back on just a little bit. We're going to come in here again. We're going to go back to 0 days till expiration. I'm going to put these all on the same ticket because I want to hold it all day long. So we're going to go in here and we're going to sell this one. We're going to sell this one. Then we're going to go to 1 day till or 3 days because we have to do Monday. And we're going to buy the call out here. We're going to buy this one. And we could actually go out one more because we think the market's going to go down, and then we buy this put right here. So we buy the close in. So we kind of skew it a little bit to the put skew to the downside. All right, so we're going to pay $300. We have a margin requirement of $684 to put this thing on. We're going to collect $1,600. No, not $1,600 because that's. We're going to collect $4 or $5, almost $1,000 in premium. So if that's the case, we're going to come and draw our $1,000 from here up. $1,000 is about right there. So we're going to draw our cone of probability up 1,000 and down 1,000. That's close enough for horseshoes. And now we're going to come in here and draw our cone of probability, which is going to come out. Let's just draw a little box in here, make it easier for me to find it. There we go, just like that. Now we're going to take our cone of probability, all right? And we're going to come in here, and we're going to go from here to here to here. Market's starting to rally again. That's our cone of probability with this strategy. So the market has to close inside that green box. Now, it's to be profitable, notice it's going to move around out here, and it might leave the cone of probability. It'll show a loss, show a loss, show a loss. But each time it crosses over, as long as it closes inside this cone of probability, we're going to make money. All right. We're going to collect our $1,000 in premium. Now, they're also going to assign us a position, either long or short, at closing, whichever one is bad for us, right? So whichever is the worst for us. If it would lose us money to have a long position based on our options, then that's the one they're going to assign us. If it's going to lose money for the put side, that's the one they're going to assign us. They're going to assign us the loser, and then the loser is going to have to be taken out of our profits. Plus, we've got these premium options in here, which can help us cover the losses if the market really takes off and runs. But we're going to have to pay some of that too out of our $1,000. But because it's 3 days till expiration, we shouldn't have to pay very much if we liquidate it today. So we're going to go ahead. Now the market's really starting to run higher. Do I want to move this whole thing up a little bit? That's minor adjustments here in the beginning. Okay, let's go back and look at the 2-minute chart again. The thing's taken off and going up. Where's our strike price? It's right there, isn't it? It's right at that strike price. That's where I'd rather sell it. I'd rather sell it right at the strike price, unless I think it's going to fall. We're getting a little rally out of the market right now, right when I'm trying to put this on. It's right back at the VWAP. That's where we like it, right at the VWAP. That's the favorite place to put it on here. Let's wait for a second. I got my meeting. I have to replace I wanted to really put this on in my real money account too. So as soon as I put it on here, I want to shut down our class and then go over and put it in my real money account. Today seems to be a good day to put one of these on. All right, it's slowing down a little bit. Getting a little volatility. That should drive our prices up. So let's come back to our 5-minute chart. Well, I switched charts, and so it dumped all of our orders. Let's move this up a little bit. Let's put it on right there. Let's get rid of all of our drawings. Okay, so let's do it again. Okay, we're going to come in here and sell right at the money. Okay, we're going to sell this one. What did I just sell? The call. Sell the put. 8, so it's about $1,000. We're going to buy the call here, but we got to do 3 days till expiration. It's going to buy the call. Actually, we wanted to buy this call up here, didn't we? Buy this call, and we're going to buy this put right here. So we got our skew. That's our put skew. So 687 on the put, 562 on the call. The market's still rising a little bit. Getting a little rally out of here. The spread is 15. $490. It's going to be a pretty wide spread. 485. 425. Things now, it's moving against me too fast. Okay, let's put that thing on. Didn't take it. Let's see what we're sitting here on. Okay, we got it filled. All right, we're in the market. I don't know what the heck we ended up with our spread on there. If we got some nasty fills. Multi-leg. All right, so that's our position. There's our buy call. There's our buy put. There's our zero. They're all on the same ticket, so it's going to all work together now. The market's still rallying. You don't want this market to rally when you put this option strategy on. You want it to be dead. So we want it to die. It's coming around to the 9 o'clock hour. Did we have a news event at 9 o'clock? No, we don't. We have no more news events today. So hopefully the market just gets quiet and goes through our box. Now, we can come in here and put a limit order on there and say if it hits $500 in profit, take it off. So we can come in here and liquidate the multi-leg. And we can just say, you run this up until the net profit right here, and we could just say $500, which would be 50% of the value, right? But look, 50% of the value, $500. We make $500 on it right there. That's 157% return on your money. on your risk, that's crazy. 157%. A lot of guys will wait an entire year to make 10%. And we're trying to make 157% in one day. Are you registering the knucklehead amount of money that is? That's ungodly amounts of money. So I don't need to do 15 of them. Can I? Yeah, I could. Well, no, we can't because we don't have four. Well, I don't know. This thing probably let us do, because of the margin amounts and the way we've got this thing set up, we probably could do 15 of them. You want to take that risk? Possibly. Not today. Not today, my friend. All right, let's let her rip. We got her going. We're going to let her go. There's nothing else to do. Sit and wait. Sit and wait for it to make money. It's got to stay inside that box. So the further down that box it goes and stays inside there, the more money you're going to make. All right. Now remember, we're not going to have to pay the full premium on those options that we bought, because they're going to maintain their theta because they don't expire until Monday evening, Monday close of business. So they're going to maintain their theta. So, but we don't plan on holding on to them over the weekend. We're going to just cut them here at the end of the day and pay a very small premium against what we would have had to pay had we bought them with today's expiration. We don't want to buy today's expiration. Costs us more money up front, but less money spent in the long run. And we still get the protection. I think we'll still get a pretty good protection on them. All right, guys, we're going to let this run. I'll take pictures of it, and I'll let you know how it turns out for on Monday. So Monday, we'll be back in the morning session. We don't do the afternoon session for Power Hour until Tuesday, and I'll let you know how this turns out, and we'll see you again on Monday. I got to go replace a water heater. I'm not going to replace a water heater. I'm hiring somebody to go replace a water heater. I got to go meet the plumber. See you guys later.